What's up, guys? Ron from Ronald Law, and today for our interview, we have a really exciting guest, Daniel Rickert. He is a multifamily operator, general partner in Colorado. He exclusively focuses on that area for several multifamily acquisitions. So we're going to be sitting down with him to talk about his background and what led him into real estate. So Dan, thanks for joining today.
Hey, I appreciate you having me, Ron.
So we've been talking a little bit, just in terms of the background. I think it's super, interesting. Why did you come down the totem pole to, simple real estate, which is a lot less exciting?
So I actually started my career at a company called Northmark Capital in Dallas, Texas, and I was originating debt and equity there. So I got exposure to all types of commercial transactions, right? We were doing ground up development, refinances, recapitalizations, and we were placing capital all up and down the stack, right? So everything from senior loans to preferred equity, mezzanine debt, common equity, kind of you name it. I was getting an opportunity to really see the real estate game from that perspective, where I was kind of a mile wide and an inch deep. I was always more interested in the actual operations of the assets and executing that business plan and not just putting together the capital stack. I moved from Dallas to Denver, where I'm now, got in on the ownership sponsorship side, put together the capital stack for my own deals now, do the day-to-day grind that is operating and owning multifamily assets.
Real estate is unique. It's the only asset class or the job that is fun. Nobody else would like to do the grind. But I've got clients in their 80s and they just love real estate. They love buying and selling and doing the operation. So I think you're not alone in that. It's been a couple years, right?
Yeah. So we turned 3 years old this past May, transacted on almost $80 million of real estate over that time frame. We've had 2 successful exits. And what I think is really cool is there's still a part of me that hangs on to that. So we've done everything from newly built Class A student housing deal to, some deep value add workforce deal where we were buying from an owner who'd had it for 20 years and significantly below market leases and executing a pretty heavy renovation strategy. That's a part that I love, finding all the little nuances just within the multifamily space.
Yeah, I think that's a great point in that people still don't understand within multifamily, within residential, there's still such a wide range of asset class, sub asset types that you can specialize in, you can find a return. But what's been the unifying theme besides just return?
Yeah, it's interesting, right? Because you could definitely use location as a unifying theme. Everything we've bought has been within an hour of where I live.
Got to help out, right? In terms of vendors and contacts and.
Well, and maybe I'm too much of a control freak, but it's like, I love being able to say, oh, I just finished up a meeting over in Cherry Creek, downtown Denver. Maybe I'll swing by my property on the way back to the office. And, our community manager is going to be there. I know her Starbucks order. I'll pop in, bring her a coffee. We'll see how things are going today. You pop in and you have that kind of informal conversation and they get comfortable with you as the owner, because you get a lot of FaceTime with them, as opposed to saying, okay, it's the 15th of the month. We just received the monthly financials. I'll be at the property at 2 p.m. to review with you. I mean, everyone's going to be a little on guard, a little buttoned up, but when you just kind of can swing by, say what's up.
No agenda, no preparation. Yeah.
Yeah. You just get to know. And then, you still have to have those formal sit downs where you say, all right, we need the regional, we need the on-site, we need to talk to the accounting team and have everybody in one room. I'm not saying that you shouldn't have that meeting, but there's a lot to be said for those quick, easy conversations.
No, that's a great point. I think what you're describing is what comes to mind. It's the exact opposite of when somebody describes it as an absentee owner. We hear a lot about this absentee owner that lives in California, neglects the property, maybe comes out every now and then and stays in touch, but they're an absentee owner that doesn't walk the property and understand when the tenants say like, oh, the parking lot's really bumpy, like we need to resurface. And you're like, oh, we just did it. But you parking your car in there and you trip over a root, you'd be like, yeah, this is an issue. We should take care of it. And it really changes, I guess, your relationship to them, because it's very personal, as a local owner. Yeah,
Yeah.
to some
And
degree.
and I've always wanted my, our management teams, and we use third-party property management, but I want them to feel like I'm a resource to them, right? It's not, oh no, the big bad owner's coming down and he's gonna, tell us we need to raise rents and reduce vacancy and collect the bad debt and cut expenses. He's gonna be all over us. It's like, no, this Daniel's coming by. He wants to help. So it's, you don't say, how do we do that? It's like, what do you guys need to lease these units faster? What can
Yeah.
I provide for you? And, that's what my asset manager is really good about. She's always saying, what can we do to help? Because we understand it's not easy managing these assets. And our job is to get the best performance out of the property. And a lot of that is going to come if your management team is excited to go into work every day and they know that at the end of the day, you have their back, that
Yeah.
you're not the villain in some cases. But I think some of those absentee owners, whether they realize it or not, they're so far removed from the reality of what's happening on the ground that they become out of touch with what their managers are seeing and what the managers are having to go through every day.
Yeah, I think you describe it as it's that combative kind of relationship, and it doesn't matter if it's true or not, but if it's perceived that way,
Exactly.
then perception is reality there. And yeah, it can be hard to describe the challenges that they face in terms of why they can't raise rents unless you're there. And you say, look at our comps. You walk into these lobbies and they've got 10-foot ceilings and great music and built-in speakers. That's a atmosphere that you can't necessarily just replicate or say things like, we need to match their lobby to have that first wow impression.
Mm-hmm.
And the owner says, okay, we have on paper everything the same. Why, and you're saying it doesn't feel the same. We need to do X, and you could do it by walking a comp or something.
Because I think at the end of the day, what draws people to real estate is it's a high touch asset, right? You can stand there on a corner and say, I like the way this feels. And you might not even be able to put a, adjective to it, but it's like, oh, I like the way the trees are and it's kind of quiet, but it feels vibrant and I feel safe and it's clean. Or it's like, man, there's just a really good energy here. And, with being on the finance side and the investment side, sometimes you just get so wrapped up in the spreadsheets and the numbers and trying to find that next deal that you lose touch with what it is you're actually buying and owning and operating. And that's really good real estate.
Yeah. I think you've touched it on all. And I've heard that a lot. Those are actual real factors that move the needle, which is safety and cleanliness. It is difficult to convey or to prove safety.
Mm-hmm.
And I don't know, there's a meme on the internet, I should find it, says like, an apartment is expensive if there are single girls walking their dogs. But it is absolutely a metric that 100% it drives demand. If people feel, if single women tenants feel safe, that's huge. And it's really a gulf between, it feels, if they get that feeling when they tour that it's not safe, they're not going to rent. And it puts you down a downhill.
You'll never see it on a spreadsheet, but you know it in your gut. And it's funny that you say safety and cleanliness, because when it comes to the operations, our two KPIs and, kind of like our broad overarching theme that we use to make decisions is clean and safe, right? So if our management company comes to us and says, hey, we need, to do a bunch of concrete flat work, it's going to cost $30,000. We turn around and say, is this going to make the property safer? And Clint's like, well, it fixes some trip hazards and, it's going to help people who maybe are ADA or something. It's like, cool, that's fine. Safety and clean, go. And, we do the same thing. I drive my wife to any property that I'm bidding on. And I just go, Kelly, how would you feel living here? And if she says, I wouldn't feel comfortable. we'll drop out. I mean, I know it sounds stupid, but if I look at the numbers and they make sense, we drive by and she doesn't feel safe, we're not going to do that deal.
There's
Unless
always more deals.
you can do
Yeah.
that.
Well,
Really,
maybe now in this environment too, it's coming around. There are always more deals, and that's some real estate advice that I got from a mentor a long time ago. Never chase deals, no matter the environment. They're giving you this mentor advice from 30 years, 40 years of investing. They're like, it's a cycle, it's temporary, it will come back. Do not feel temptation in a moment of weakness just because it's a tight market, just because it's a seller's market. And he said, there are always more deals. Don't reach for something, build your underwriting and have your process maybe where you drive by, but there are always more deals. And it's, it's coming back. I think the pendulum is definitely swinging back to buyers, but if you listen to that advice, you're not going to be caught in a Apple's way, foreclosure situation. So,
well, it's kind of Warren Buffett 101, right? He's got all those great sayings, and one of them is be greedy when others are fearful, and fearful when others are greedy. The last 3 years, right, of Notch Mountain, it's been super interesting because we start the company and we're in kind of COVID 1.0, right? May 2020, we're just coming out of that first like real lockdown period. Things are pretty funky. 2021, floodgates open. It's bonkers. 2022, we're on this treadmill where rates are doing this and deals are falling out left and right. Nobody can get their footing. Nobody knows what to do. And then 2023, I mean, it seems like people are almost a little shell shocked where they're just kind of saying, I can't figure out what an appropriate value is for anything. The debt's definitely stabilized compared to last year.
right.
But it's not a cakewalk. Sellers haven't quite, realized how far the market's come in, or they don't have to acknowledge it yet because they have term on their loan, whatever it is. So they're sitting tight. Buyers aren't ready to reach yet. So it's just, we've had 3 years here, and every year has been so different with its own super unique challenges.
Yeah, well, I think it's good that you're able to focus full time on it and really kind of dedicate that. I see, I don't know, the syndicator world is kind of shaking out into two camps, right? There are the people that were still doing a W-2. I'm a full-time engineer and I'm a full-time doctor, raising all this money and buying apartments. But then there was the other side that are like you that quit and went full-time. And those full-time operators, they almost took a more conservative underwriting and didn't grow too much because they knew that they were focused on this and like, I can't lose properties and I got to stay on my stuff. I'm going to reduce my lifestyle or whatever it takes. They're almost in a better spot now with low LTVs and stabilized everything. They aren't trying to keep too many balls in the air, I guess, versus some of the part-time people. They've got eight GPs on a deal and they're trying to raise $9 million and they're coming to the deadline and they're short. It's really interesting how quickly they came into the market and how quickly they're exiting. So
I might regret saying this, and I really don't want to offend any of your listeners, but I truly believe this. I'm going to say it. When it comes to the part-time folks, and I've had these conversations with peers, with friends who say, I've got this job, but real estate's really appealing as an investment class. I want to get in, but I don't want to pay fees or promote. So I'm going to go do a deal myself or get in on the GP side and raise some capital. Anybody who's doing it part-time, I don't think it's possible, candidly, because I'm out here, to your point, doing it full-time. I'm in the market. So I'm talking to brokers, investors, lenders. I'm talking to institutional equity. I'm talking to syndicated equity. And right now, with how quickly things are changing and evolving, if you're not having those conversations, and we're on the phone 4, 5, 6, 7, 8 hours a day, and really having that boots on the ground approach, you can't do that if you have a full-time job and you're trying to hustle this part-time, and if you're not that in tune with the market, you're going to miss the boat. You're going to miss when the tide's going out and things are getting more difficult. And then conversely, you're going to miss when the opportunities start to come back your way. And I don't care if you're 10 times smarter than me, you're not working 10 times more hours than me with a part-time real estate syndication.
No, absolutely. I have no problem in insulting half of my listeners. That's fine. Smash the dislike button on this. Yeah. But no, I mean, I think
take it out on Ron. Take it out on me.
But when things are going bad, you know, you have this lag between your underwriting and you go under contract and closing. And a lot of people make assumptions that may not be true 60 days or, you know, for 90 days from when they go under contract. And it's crazy, to your point, how quickly it's changing, and whether that's good or bad. Right. I think people have been saved by cap rate compression and just an overwhelming amount of capital coming in. That has saved a lot of people's bacon. But now when things go bad, it's just seeing some pain.
Because, yeah, and you touched on a really good point there. Real estate's an illiquid asset class. You don't go log into your Schwab account and say, oh, the S&P's up, the S&P's down. Let me go look at the last 30 days and just quickly say, okay, I kind of have a sense of the pulse. To your point, deal goes under contract. It might not close for 90 days. That deal, let's just say it goes under contract at $10 million. 60 days in, there's a retrade for $1 million or $2 million. You, as the part-time guy, might have just seen it go under contract for 10. But I would just toured another deal with that broker and I said, hey, how's that deal going that just went under contract? He's like, you know, it's coming. And you're like, they retrade? He's like, yeah, don't tell anybody, but. And so now I know, all right, that's not a comp, right? And whether or not I want to take kind of a sales comp approach to a deal I have in the market or something, it's like, that guy's either having trouble raising equity, his debt came in higher. And so, you know, you just earmark that in your head and you say, all right, I'm going to go and have a conversation, or you talk to a mortgage banker about a refi for one of your deals and say, what else are you seeing out there? And you just pick up these little tidbits that aren't publicly available. I mean, it's still an industry that there's a lot of asymmetric information. And that's why guys like us that are full-time have a lot of value.
I 100% agree that the asymmetry of information, people will say things, maybe not on a recorded Zoom call, but they will say things in person that they are not going to put in writing, you know, right. And maybe that's true from brokers, from lenders, from property managers. I've heard through the grapevine, like one of the best ways is to get in with the property managers, and they will tip you off when a property is thinking about going on the market to sell, because they want to keep their job if they transfer, and they'll be the hero of the management company. But yeah, if they just give you a little tip, it doesn't cost them anything, but they know if it does sell to you, you're probably going to keep them on, or you know, at least something.
Yeah, one way we've sourced deals is just that. I mean, we bought a student housing deal at Fort Collins, closed April 2022, and it came our way because I got a call from the property manager who had been, the deal was under contract, they were going to manage it, and then this property manager called me and says, hey, the buyer's 1031 down leg fell through. The broker's scrambling to find a buyer. This one actually makes a lot of sense. You should take a look. And coincidentally, the broker called me like an hour later. And I was like, this wouldn't happen to be that deal. He's like, how'd you know? I was like, well, little birdie told me I got a beat on it. So we were able to put it together, you know, before anybody else got a second shot at it, before they started working down the rest of the call list. And it's been a great asset for us so far. So kind of interesting how that can come together.
Yeah, 100%. I think one of the things I talk about, I feel like you have a very good elevator pitch. You meet anybody in your market, and in 30 seconds, you know, what do you tell people you do?
Oh man, it depends who the audience is, because
somebody in real estate, somebody in you know, commercial real estate. Yeah,
I buy apartment buildings in Colorado's Front Range, so. You know, I think I can confidently say if there's a deal between Fort Collins and Colorado Springs, right? Because, Colorado, most of the population lives on the eastern side of the state. I-25 is our big north-south thoroughfare. So you got Fort Collins on the north end, Denver in the middle, and Colorado Springs on the south end. And Denver, it's an hour north to FOCO, hour south to the Springs. I mean, if any transactions happen up and down that corridor, there's a 80 or 90% chance I've toured the asset.
So they're not closing without your permission. You become the godfather of the corridor.
I'm not quite there yet. I'm not a deep enough local to be pulling any strings like that, but I like to think I've seen it. And, I underwrite just about everything because worst case, you add a data point and you never know if you're going to be pursuing the deal next door in a couple months, couple years. And you kind of look back and say, oh, I think I have a file on that property.
Yeah, I was just going to touch on that. So that's something that is super cool. I have that for industrial, for my wheelhouse, my buy box. Somebody will mention something like, oh, there's this property, and they'll mention a characteristic, and I say, what city is that in? And then I'm like, give me 30 seconds, right? And I have it on Google Drive, and I'm like, oh yeah, I've underwrote that. It was for sale 3 years ago for $8 million. And then they're like, yeah, Ron, now they're asking 6. I'm like, did they do anything to it? And they're like, no. And I'm like, maybe I'll take a look at it.
Yeah.
But it's incredible how small the universe is the more you narrow your buy box. And I don't know, I have probably 50, 75. I mean, for me, it's a lot. But within that buy box, I've got a lot of due diligence on a lot of and it's all public. It's my own model. It's, an aerial shot. It's maybe a survey if I have it, the prior seller. And it's super interesting to see it come around. And for me, it already comes around where people will try to sell you the same stuff.
Yeah.
Not that it's a bad thing.
No,
I would say I'll buy anything at the right price. I've done my underwriting, and when they were asking 8, I came up with a value of like 5.2, and I was like, I'm not even going to offer because it's a little bit far off from their expectations.
Sure.
Versus now at 6, okay, maybe I'll underwrite again and I'll offer 4.5. In this market, you can. In this market, it's very interesting. The sellers who want to sell are really willing to work with you, and if you come with 4.5. They'll counter at 5.7. And then you say, okay, how about 5.5 and seller finance, X amount. And then they're sometimes able to do it and make the deal cash flow and pencil. And that's how you get deals, I think, in this environment, because you can tell them too, like, hey, you tried to sell this for 8 million. I'm not going to pay you 6 for it. And they're kind of sheepish and they're like, okay, fine. But how much do you want to pay? And you can defer it. Yeah.
So we call that hanging around the hoop, right? And I think that's a really helpful phrase because, to your point, it's not like in 21 when an LOI was accepted, that deal was closing. There was so much liquidity. There was so much, money floating around that it was almost more difficult not to close than to close. There's just too much momentum. And now it's the complete opposite, right? The liquidity is all gone. Investors are on the sideline. Debt's more expensive. It's harder to get deals done. And so just because something went under contract doesn't mean it's a sure thing to close. And if you kind of hang around the hoop, the seller went under contract with the highest bidder who wasn't the most credible, because he saw the green flash in front of him. He wanted the money. But now he's kind of beat up, right? He spent 60 days under contract. They retraded him twice. And then at the end of the day, they still couldn't close. So then you're, calling the broker, you're calling the seller saying, hey, how's it going? Like, how's that deal coming along? It's like, well, say, hey, I mean, we're happy to give you an offer. Let us step in here. And
sorry, go ahead.
Oh no. And so that's just where I think you find some really compelling opportunities. You got to stay hyper focused because, in 21, it's like, all right, that deal's gone. Now on to the next one. It's like, don't forget about those deals now.
Absolutely. It's again, I've heard this advice. It's like you have to prepare for the cycle because you're still not even beating up the sellers yet. they're still in the money. I mean, they're still profitable. You're just taking them down from, an astronomical return to, it's a pretty
Right.
good return, but I want to sell because I want to do something else, or I want to buy or build something else. I just want to free up this cash. Because in the cycle, again, I had this other mentor. He was telling me, you've got to beat other people up to the maximum extent. Real estate is a cycle, and you will get beat up. And if you don't, it's your duty. It's your ethical obligation to beat up the seller, to get him as low as you can, because you're going to be on the other side of that table. And when you need to sell in a downturn, you're going to get beat up. And so if you don't take the advantage when it presents itself, karma doesn't do you any favors, especially like with lenders. 10 years ago, I specifically remember 2013, impossible to get financing.
Yeah.
And new construction, I got like 40% LTC construction debt. And I was like, this is insane for multifamily. And you fast forward to 2020, you could get 95% LTC for multifamily in Dallas and Texas.
Wild.
Lenders were just pushing out the money. And the contrast, nothing has changed. That could be identical deals. I mean, they weren't, but like the general size, the loan size, the sponsor credit, identical, 40%, 90%. And I remember this guy was just telling me, he's like, oh yeah, F the banks. They're all sheep. Nobody moves independently. They always ask, who else are you talking to? Who else is extending?
Sure.
And if you tell people like, oh, Frost is going to do it, or Texas Capital is looking at it, then they'll be like, okay, we'll lend.
Yeah.
When they know that lending is tight, and they, because again, you can't really BS, right? When you don't have a term sheet, you cannot go to some Texas bank and be like, oh yeah, so-and-so is looking at it, because they'll call them up, be like, you guys are lending? And they'll be like, no, we're not.
Yeah.
And you get called out. So you have to just be candid and be like, well, we're working with you. We have a relationship. We've got deposits, whatever. But right now, you're the furthest dog. And then they'll back away. So anyway, it was a lot of resentment, but not anger. It's just the way things are.
Yeah.
That you get beat up, and then the cycle comes around and you got to beat them up. So I'm glad you're taking advantage of it, but for everybody out there, it's just a cycle. And the only lesson in that to me is you have to stay in it for the long term, so the wheel comes back around and you get in your position to beat up on other people.
Yeah, I think the comment there about the cycle and the wheel coming around, I think that's an important topic to touch on for anybody listening, just because what happened in 21 is, in a lot of ways, we lost sight of the risk involved in real estate. And one thing that I think a lot of, smaller first-time investors don't necessarily understand is I could show you an identical deal, same location, same cash flow, same NOI, but the way you finance it is going to largely dictate where it sits on the risk-adjusted return spectrum, right? Over here, I could say 3-year floating rate bridge deal at 85%, or 50% fixed rate 7-year debt. And the floating rate deal, you might hit a home run. I mean, you time the market right, it's got less prepayment, and you're able to exit in 2 or 3 years and do really, really well.
Don't waste money on rate caps. That's just burned expense. Yeah.
That's been the best investment any of us made. Those $30,000, $40,000 rate caps we bought in 21 that are worth, $500,000 today.
If you can even buy them, if you can even get it. So.
Well, so on that note, most people don't realize that there's a whole market for rate caps, right? Mm-hmm. That you can buy them, you can sell them, you can extend them. I mean, it's simply a derivative, right? It's a financial contract. So if you have a rate cap, it's probably in the money right now. And that means that the index rate that it's tied to is higher than the strike on the rate cap.
Okay.
And so it's paying out every month. So there's a future stream of cash flows. And investing is actually really simple, right? What are we always doing with investing? We're saying
time value of money
much for a future stream of cash flows. Yeah. And then I come up with a value by discounting it back to the present. So same thing could be said for a rate cap. I'll pay you $100,000 for that rate cap because it's going to pay out $20,000 a month for X number of months. And I think that's a profitable trade to me.
Well, okay, so this is great. I appreciate the education because I did not know that level of detail. In your example, if it's 20,000 a month and somebody's willing to pay you 100, their implicit bet is that the rate will stay in the money for 5 months or greater.
Mhm.
And you're kind of saying, no, I think it'll be less, or I also value the cash now more than the next 6 months of cash flow, even if you agree with them. But the buyer is almost definitely saying, I think it's going to pay out for more than 5 months.
So
be positive. Yeah.
So yeah, this is actually, I'm glad we kind of opened this conversation super open-ended. We were just like, let's talk about real estate because we both love it. And I'm glad we stumbled into this because people have gotten smarter on rate caps. They've had to, but 3-4 months ago, I was getting calls from all of my peers saying, what's a rate cap? I don't understand this. And
well, who's responsible for evaluating the investment need of a rate cap? I mean, do the mortgage brokers help any of these people, or is it purely a sponsor responsibility?
So really good question. And I think it's helpful to define kind of what's a rate cap for those that don't understand. So a rate cap is going to have a couple of inputs, right? It's going to have a nominal amount. So $1 million, $10 million. And typically that's going to be tied to the loan amount, right? Because you're hedging interest rate risk for a loan. So $10 million loan, $10 million nominal. It's going to have a strike. And so if your loan is tied to the secured overnight financing rate or SOFR, you'll have a strike tied to SOFR. And then it's going to have a term. So how many years will that contract be in place? High level, that's all you need to figure out for a rate cap.
To price the rate cap.
And so then, and if you're really interested, you can actually go to Chatham Financial and they have an interest rate cap calculator where you can put in those 3 inputs and figure out what the pricing for a rate cap would be today. And so what we were seeing is largely the rate cap purchases were being driven by the lenders.
Requiring them.
And oftentimes the term was coterminous with the loan term because in the lender's mind, right, they're looking largely at a DSCR, debt service coverage ratio, and they want you as the owner of the property to be able to service their debt. And so they're saying, okay, we'll give you a 350 spread, 3.5%. And in 21, SOFR was 6 bips, 9 bips, 0.06%. And so at the time, your NOI divided by your debt service, which had a 3.75% interest rate or something around there, had good coverage. But the lender knew that the rate's floating, and nobody that I know really predicted the rates increasing as quickly as they did.
Yeah, as quickly as it is. Everybody would have agreed on some increase.
Mm-hmm.
But we would have thought 1/4 point, 50 basis points, 6 months. We would have time for sellers to adjust and for a market to adjust, raise the rents, whatever. But man, month after month after month is like.
It wasn't the increases. We all model that. It was the speed that just killed everybody. And so the lenders are saying, I need to protect my risk that the floating rate debt gets so expensive that my borrower can't service it. And so they required you to put a rate cap in place. So oftentimes there's a little bit of a negotiation there in terms of, what strike, what rate you're going to cap the index rate at. And even the term, right? Some of the bridge lenders said, instead of doing a 3-year term, we'll do a 2-year term. That way you can buy a cheaper rate cap. And so there was some creativeness around that. But what ended up happening is you would go and you get on the phone with a rate cap broker. I mean, those exist, guys whose entire job is to help folks, whether it's in real estate or in corporate debt, hedge floating rate risk. And there are banks that will sell you that contract, just like a options contract. And, you paid them X amount And then depending on how much term's left, depending on what the strike is, depending on what the interest rates are, depending on the nominal amount that that rate cap covers, you can then sell it. Now, likely your lender doesn't want you to sell that rate cap because then it means you probably can't cover your debt service as easily. But when you
Well,
go,
you just have cash. Again, you're
Yes.
trading the value of the rate cap for cash in your pocket, and they don't want to see a distribution to the investors and everybody. So then it kind of circles back to your loan docs. What are you allowed to do with excess cash, and whether you have a lockbox? There's all sorts of very interesting things because we're working on one refi on Fannie about distributions to the GP and stuff, and that would fall squarely. It's not rent, it's not income, but it's other income. But is it? It's weird. I think it's almost a product of the sponsor borrower. It's not related to the property. It's a pure financial instrument. So you could make an argument that it's not subject to the lockbox sequestration requirements, if any, because it's separate. And that's what the lender is concerned about. But yeah, it's it can get sophisticated really fast, and it's shocking to me that my clients have been buying these, but this is the first time I've heard of a rate cap broker, because I didn't know that I just thought the sponsor was like, oh, we need to buy it, or the lender requirements. And this actually another follow-up question. Do you think the lenders were requiring them on weaker borrowers? So it's almost the sharper lenders saved the weaker borrowers, because they wouldn't require it for deep-pocketed sponsors that could say, hey, if the rate goes up, we can cover it with our reserves. Or who was being hit with the required rate cap, I guess, is my question.
So typically what you're seeing, right, is any loan that, and you're going to be more familiar with this than anybody given what you do for a living. It's anyone that's securitized has stringent requirements, right?
Yeah.
And so you get a Fannie or a Freddie floating rate loan, they're going to require a rate cap, but there's not going to be a lot of ability to change those loan docs, right? Because that's a securitized loan product, and they're selling to a pool of investors who's going to buy that loan pool, and they are buying it with the knowledge that there's a protection, a hedge in place against rates moving too fast. And so in 2021, there was a lot of bridge debt that was what's called CLO, which stands for collateralized loan obligation. And so it's the same thing. A bridge lender would go out and say, we're going to go and do $10 to $25 million loans and top 50 MSAs.
Starting to sound like 2008 again.
Well, it's funny, right? Because you do run that equivalent. Everyone, you'll hear sponsors say, I don't want to do any CMBS debt. I know what happens with CMBS debt. But then they go and do that bridge loan. You say, that's a CLO. And they're like, a CL what? It's kind of like we just took CMBS and we put a different name. And there are some big differences. But
I wouldn't care. Why does the borrower care? I mean, they're the one getting the benefit of a higher credit rating for their debt that's actually lower quality. So they're getting cheaper debt. So the borrower shouldn't care.
Correct. So the borrowers were fine with it. And it was interesting because some sponsors were kind of resistant to being forced to buy these rate caps in 21 because they felt that rates aren't, it's a 2.5% strike. Do you really think SOFR is going to go from 9 bips to 250 bips? There's no way.
Yeah. Or if it does go up, we will sell. When it goes up 50, we'll sell. They just didn't think that they wouldn't be able to sell. And it's funny, it's exactly the strong assumption. Again, I don't know if you read Big Short, where it talks about that. People just had this thing where they said, well, all of these loans won't default. They're spread out. They're so national. And what they didn't realize was like, wait a minute, you don't understand how they're being constructed. They are all the same borrower. And once that light clicked for, I forget the guy's name, whoever was shorting it, they were like,
Michael Burry.
Wow. it's terrible. It is all the same borrower, and it's going to collapse, and it is collapsing now. It's just a huge house of cards.
So one of my favorite quotes of all time, and I have it taped up in my office, is the most dangerous time is when we start believing our own lies. My dad told me that, I think, when I was maybe like 10 years old. And so it's just always been in the back of my head. And I think it applies really well to investing and investing psychology, because you look at the deals you might have underwritten as a sponsor, looked at as a LP in 2021, and you're saying, we'll sell this for a 5 cap in 3 years. We can sustain 7% rent growth. Expenses won't grow that much.
Yeah.
And I think,
or they said all 3 won't happen at once.
Yeah.
They said, well, we can handle 1 or 2 out of the 3, but all 3 won't happen at once.
And I think in your gut, you probably knew, like, things feel a little overheated. And it's tough because there's always going to be,
you miss out on deals. If you sat out from 2019 to 2021, you missed out on a boatload of money for sure. Yeah.
And so, I mean, I was having that conversation. My dad's in property management and he's bought a few deals, and we were having this conversation the other night because he said the exact same thing. He's like, I just don't understand how people bought all these deals. And I was like, well, I mean, it was because we'd been talking about interest rates going up for a decade, and everybody who sat on the sideline was just sitting on their hands. They couldn't do anything, and they missed out on all of these returns. So I don't fault anybody for doing deals and keeping going. I think it made perfect sense.
Yeah.
But you had to know that at some point there was that party.
Music was going to stop, and you just don't want to be the one, without a seat. That's the kind of the simple answer. And I'm happy to kind of wrap up everything. If you're done, is just, it was great learning about rate caps, but really showing how much some people don't know. And it's scary because if you don't know what you don't know. And this was a perfect example of a lot of these part-time syndicators not even being aware of this, or much less understanding how to calculate or to the need to evaluate whether to purchase them. And it's an interesting time, but the rate caps are coming front and center. I'll quote this. I love this one too, is good debt cannot save a bad deal, like a real estate deal, but bad debt can absolutely kill a great deal.
Yeah.
And that's kind of what we had with the variable bridge stuff. Was that, looked, in hindsight, turned out to be horrible debt. That is really, causing some struggle. There's capital calls. Operators are pausing distributions, and they're figuring out how to move forward. So
I'll say the same. I'll put this back on you. A good sponsor will make a bad deal work. A bad sponsor will fuck up a good deal. I guarantee it. So, I think at the end of the day, knowing that we go through cycles, knowing that times get tough, who you invest with is as important as what you invest in. You're betting on the jockey just as much as the horse.
No, absolutely. I think, management is everything. It's really key that if you're a passive investor or you want to be the manager, that you can dedicate the amount of time, focus, expertise to really stay it for the long haul, because you might own this property for a lot longer than you anticipated. I mean, you own stuff and you're saying, like, look, can we sell? Yeah, things are trading for a 6 and a 7 cap. We don't want to sell. And you may end up holding it longer, doing distributions, clinging to your fixed rate debt, and saying, like, look, we're going to push this thing out 7 years until we have to make a decision, but we're not willing, we don't need to sell. And that's a different assumption than I think a lot of people make. They thought it was Beanie Babies, Bitcoin, jump in, make a little money, jump out, under the same assumptions.
Yeah.
And it's really not. I mean, the world is changing, and
it's a grind. It's a grind. And
you got to love it though. You got to have the fun. I would say that's my threshold. If I was ever investing with somebody, it's like, do you love real estate? And if their answer is not an emphatic yes, I do real estate in my day job. I do commercial real estate as a lawyer. I make videos for fun.
Yeah.
And I go home and I chat my wife's ear off about commercial real estate
Yeah.
until she's like, stop. All you do is talk about real estate. Like, I'm like, I'm sorry. I just,
Have to.
yeah. And I invest my own personal capital in real estate. So it's like that trifecta of everything, my work, my hobbies, and my money is all in commercial real estate. But Dan, it was great chatting with you. I really enjoyed it. And, we didn't get to talk at all about rock climbing, but
yeah, anybody knows me knows that, that outside of real estate, that is the one other thing you'll catch me doing. So maybe save it for another
I mean,
time.
I love the analogies. So we'll do another video, rock climbing and real estate analogy, race car driving, real estate analogy.
I like that. There might be something to that.
Because I think it's good in that if it helps people understand more their real estate investing, like even me, right?
Yeah.
I don't consider myself an expert, but I know a fair amount. If you can give me an analogy that opens up my mind to something more about the way I think about financing or debt structure, something, risk like falling off. Is there anything that you would take a risk for of not belting in, not clipping in? And you would tell me like, no, in commercial real estate, you have to lock down your debt before your money goes hard to some degree, or, you need to have the equity. And that is an equivalent of like, you've got to do this or you'll die or you're dead, or you have to be willing to lose your earnest money. And maybe that would be super interesting. So
we'll have to do it. That'd be fun, man.
Okay. Well, thank you guys for tuning in. This was a really awesome discussion with Dan. I'm going to rename the interview Rate Caps, an interview with Dan. But smash that like button if you're still watching. Subscribe for more commercial real estate content, and we'll see you next time.